as a part of our fall fun. Sorry, let me start over. As you can see, this is a part of our fall financial series. This class is called Financial Foundations. And as a part of the University of Arkansas, we would love to welcome you to this complimentary program of the ASBTDC of the University of Arkansas. We're really happy to be able to bring you these educational videos as a part of this series. Just want to tell you a little bit about the ASBTDC real quick. If you don't know about the Arkansas Small Business and Technology Development Center, we're a one-stop shop for startups and existing small businesses. We're associated with the University of Arkansas, as well as a Small Business Administration and some other private local foundations. And we have a network, a statewide network of affiliated ASBTDCs that are affiliated with most of the major universities. We've got branches in Fort Smith, Russellville, Little Rock, and Jonesboro, and a couple of other places as well, like Magnolia. And if you're located in Northwest Arkansas, that's who this video is offered through, and you'll be talking to one of us if you're located up here. We offer complimentary one-on-one consulting and programs that cover relevant topics for business owners. And if you're not already a client, we would encourage you to visit us at sbtdc.uark.edu and click Get a Consultation in the top right-hand corner of the website to sign up as a client. We would love to chat with you one-on-one. And so there on our screen, you can see our phone number and the website, as well as our main admin email that will redirect you to one of our administrators so they can get you connected to the right consultant. My name is Scott Lacy. I'm an ASBTDC consultant. My specialties are finance and startups, so entrepreneurship, new businesses. My background is in corporate finance. I've also owned two of my own small businesses, both with my wife. She is currently still running one, and I help her with that a little bit on the side. It was a spa product wholesale business that sold spa products to wellness companies, retreat centers, that kind of thing all across the country. And so with that, we were going to get right into this. And this is meant to be a short, bite-sized class, so we don't go on and on and on for a long time. We want to be able to give you some information really quick. So this is going to be about a 30-minute long, maybe a little bit less, presentation about financial foundations within 10 minutes at the end, just for some questions that you have. And we've got two ways for you to ask questions. So let me show you what those are. So if you see this bar right here at the bottom of your Zoom screen, if you're on Zoom, you can either click chat or you can click Q&A, and both of those ways you are able to type in questions that we'll get to at the very end. So with that, let's get started. So what do we all want to know about our business, especially when we get started, but definitely while we're in business? So the two questions that every single business owner always asks at the foundation of every business is, how do I know if I'm making money or progress? And two, how do I know how my business is performing? Because we all get into business for a reason. We all want to know these questions, the answer to these questions, because we all get into business with goals in mind. We don't get into business usually just to be in business. There are those people out there who just enjoy business as kind of a hobby, and they sort of do it whether they make money or not. But that's not most of us, I think we would all admit. So we are going into this in order to make money, to provide for our families, our futures, to reach specific goals. But when we go into business, sometimes it's difficult for owners and entrepreneurs to understand, how do I know if I'm even making progress? How do I know exactly how much money I'm making? How do I know how my business is performing? And so today we're going to begin to answer those questions. Like the title to the webinar says, these are the foundations to the rest of finances. Sorry about that. Let me put that on Do Not Disturb real quick. Apologies. Where's my Do Not Disturb button? There it is. Okay, great. All right, that's taken care of. So we want to know how our business is performing as well. This is the foundation. This is just an introduction to help you understand where the tools for evaluating all your business come from. So we're going to get that set up for you today. So when you're looking at numbers, you know where they come from. You see the foundation of your business. So how do we come up with the financial foundations of a business, or what are the financial foundations of business, and how do we go about getting those? And so, in my opinion, the two real foundations, especially the financial foundations of a small business, are these right here. It's bookkeeping and accounting, and then the financial statements and reports. So I'm going to kind of go in reverse order here. I'll start with number 2. So the financial statements and reports are the statements, reports like your income statement, your profit and loss statement, and the reports like your sales reports that tell you how your business is doing. And those reports are generated from bookkeeping and accounting, which is what we're going to talk about today, because it's the bookkeeping process and the accounting process that sets the foundation, that plugs in the numbers, that plugs in the data, that feeds the financial statements, that feeds the reports, that enables us, that empowers us to be able to get that data, to be able to make good decisions about our business and to know specifically how our business is doing. So now, later on, when we go in another webinar and we look at financial statements and look at records and reports, you're going to know where all those numbers come from. So we're going to dive into that now, and it comes from bookkeeping and accounting. So first off, what is the difference between bookkeeping and accounting? We hear those terms thrown around a lot, and sometimes people use them interchangeably, and they're not really meant to be, but it's hard to kind of understand what the difference might be. So I'm going to explain that difference to you real quick. So bookkeeping and accounting, here's the difference. Bookkeeping has primarily to do with the actual physical keeping of the records. They take the numbers, they take the receipts, they take the data, they plug it into the system, whether that's pen and paper, Microsoft Excel, or QuickBooks, or FreshBooks, or some other kind of software, and they plug in the data that's going to spit out the reports. It's repetitive. It's fixed according to a system. It usually doesn't, they can't change it on their own without direction from the owner or from the CPA. And they're almost always following the direction of an accountant or at least the business owner. So it's the actual entering in of the data. Excuse me. Then the accountant or the accounting, they're the ones who usually set up the entire accounting system for your business with your input. They're going to advise you on how best to utilize the finances in your business. Sometimes they're going to maybe do a little bit of analysis for you. They're definitely going to give you some tax advice on how to minimize your tax liability to the government. They're going to help you to know what taxes that you owe and might not owe, like sales tax and income tax and corporate taxes and gains and all that, other kind of stuff that might be applicable or might not be applicable to you depending on your specific circumstances. They're usually going to oversee the bookkeeper. That's one of their primary jobs, is to make sure the bookkeeper is entering the data according to the system that you, the entrepreneur, the owner, and the accountant set up together to be able to track your business the way you want to track it. They also get into auditing. So they might come into other businesses and look and audit their books to make sure they're being done correctly. And they're also going to advise you on tax. So the accountant, they're usually the certified public accountant. They sit for the CPA exam. They go to school for about 5 or 6 years, usually to get that specific degree. And that gives them sort of the licensing to be able to file your taxes and advise you on certain matters. So they're at sort of a higher technical level, educational level, a legal requirement level than the bookkeeper. They kind of oversee everything. And then the bookkeeper is the person that you'll actually physically hand your receipts to every week or every month, or email your receipts to. And they're going to take those receipts, they're going to take that data, and they're going to actually do the plugging in of that for you into your accounting system that you've got set up with your accountants. I hope that makes sense. So there's 2 different methods to doing the bookkeeping and the accounting that is the financial foundation of your business. So the first method, sorry, let me make that a little bit more clear. So there's 2 different methods to do the bookkeeping, and there's 2 different methods of doing the accounting. So for the bookkeeping and also the accounting is number 1. It's called single versus double entry accounting, or single versus double entry bookkeeping. And that has to do with actually making the individual entries to track your expenses, your revenue, that kind of thing. And then the second one is called cash versus accrual. And what that has to do with is, when do you make those records? When do you write that information down in your official books? So the first one has to do with the method or how you do the entering. And the second one has to do when you do the entering based on your sales and your expenses. So first, I'm going to explain the single versus double entry accounting method. But a quick note before we get into any of that. Make sure that in any bookkeeping or accounting system that you have, that before you start writing anything down, that you've got all of your business and your personal accounts completely separate for both legal reasons and just practical wisdom to be able to understand your business more clearly apart from your personal stuff. So this includes your bank accounts, your debit cards, your checks, your banking accounts, your savings accounts. Anything that you have to do with your business needs to be its own separate account from your personal. Credit cards, the same thing. Don't use your personal credit card to pay your business expenses. That makes things really confusing, and sometimes there can be legal, negative ramifications if you're doing that. And some banks, if you're using your personal accounts too much for your business accounts, they can't always tell who's committing fraud and who's not committing fraud. And just as a measure of safety and legal compliance on their side, they might actually freeze your accounts if it looks like you're intermingling those two accounts too much or in a potentially fraudulent way. So just be really careful of that. Lastly, that also goes for your Venmo, your Cash App, and your PayPal cash transferring apps. And all of those will allow you to do both personal and business, or you can just set up two different accounts. So just a really quick note on that. So single versus double entry accounting. So when you're recording your expenses and your revenue, your sales, all those kinds of things, all the financial transactions of your business, you can do it one of two ways, either single entry or double entry. You want to do single entry accounting if you're just a real small business, you're a startup, you're not a very complex business, specifically if you don't have inventory or you don't have employees, and it's not really hard to see the financial performance of your business just from a single entry perspective. Or if you're real small or a startup, you can use single entry. Double entry is going to apply to basically everybody else. This is the industry standard. It's the accounting standard. It's what's required of big companies, small companies. And if you really want to see how your business is actually performing, you really want to do the double entry accounting. Double entry accounting is really hard to understand or to be able to do yourself if you're not a trained bookkeeper or an accountant, or unless you've just got a really good background. But QuickBooks will help you with that. That's what QuickBooks really does. It takes double entry accounting and makes it really simple for entrepreneurs. So here's an example of single entry accounting. It's very basic. All it means, single entry, is that whenever you have an expense or whenever you have a sale, you make a single entry. And that single entry could be you with a pen and a pencil or in a notebook, just making a single entry in that notebook saying, I spent, $1,500 today on a computer, and I'm going to categorize that as office supplies. And then let's say you wrote a check that afternoon for rent for $2,000. So then you just need to go in your little bookkeeping or accounting notebook, and you just need to write rent, $2,000 on this date, classified as rent. Internet, $150, and classify that as utilities. And it's just you keeping a single entry of every single expense. And you would do the same for your sales. For every sale that you had, you would just say, I sold one candle for $15. I sold two candles for $30. And you would just make those single entries throughout the month. And then at the end of the month, you would just take the net of those, and that would essentially be your income statement. It's a very simple, very basic way of doing things when you're just getting started. For instance, if you haven't talked to an accountant yet, if you haven't had a chance to talk with a bookkeeper, if you haven't had a chance to set anything up yet, this is just a great way to keep track of things in the beginning, so that when you do go talk to an accountant later on, you've got all of that information there, and then they can plug it in a little bit more sophisticated system. But at the very least, you want to do this because when you get ready to file your taxes the following year, you're going to need some kind of record information to be able to file those taxes legally and accurately. So you're going to want to have at least this single entry done in some form or fashion. So that's single entry accounting. Double entry accounting, this is the revenue side of single entry accounting. So this was the expense side. Here's the revenue side. So you would just do, design labor, $200. I sold $200 in design labor for this product, classified as revenue. Printing, $100. And then another potential inflow of cash that you would want to record might be like a bank loan for $10,000. And so when that money comes in, it hits your account, you just want to write that down as well. So that's the revenue or the cash inflow side, as you'll see here. Okay, so what's double entry accounting? This is where we get into a little bit more complex, like legal type stuff, where that, accountants and people have to go to school for in order to understand, in order to be able to be licensed to do. And this is what drives most of the formal financial statements that you're going to see. So double entry accounting is based on, it's not really a theory, but the accounting principle that all of your your assets, your liabilities, and your equity, everything, all of the financial information about your business always needs to be balanced. And whenever something is balanced, in your business, whenever you have a transaction, one side will go either up or down. And when that other side goes up or down, the other side also has to go up and down. And so it always has to balance. So we call it double entry accounting. So whenever you have a sale on one side, then you've got to make a record on the other side of cash. So they always balance, or inventory. So they always balance. So as you'll see, we've got the account over here on the left side. In the middle, we've got debits and credits. A lot of you have probably heard of those before. And then this chart of accounts over on the right, just to help keep track of things. And the debits, what a debit means is that is where the destination of the value is going. So the value is going to this destination over here. And the credit on the inverse is the source of where the value is coming from. So for instance, if I go, so this first transaction here at the top is just a simple inventory purchase. You as the business owner, you needed to buy inventory in order to sell, have things to sell. And so you went out and you spent $500 on inventory. And the way that transaction is going to be recorded on your books is inventory is going to be debited on the left side over here, because that is the end destination of the value. So you're receiving the inventory, that inventory has value. That's the end state of that inventory. So you're going to debit it $500. But where is the source of that value coming from? Well, it's coming from the cash that you use to purchase it. So that's the source of the credit. So on the left side of your balance sheet, which we'll learn about in a couple of weeks at our next webinar, you're going to debit inventory for $500 on the asset side, and you're going to credit cash because that's going to go because your cash is going to decrease, because that's the source of the value. And that is also on the left side of your balance sheet, which is a little bit confusing, I know, but we're going to get into that again in a couple of weeks in the next webinar. But as you'll see, it's because on the left side, on that asset side, you added $500, but you also subtracted $500. The whole equation does stay in balance. But this is called the double entry accounting system, because you had to make 2 entries for every single transaction. And sometimes it even gets a little bit more complicated than that, and you have to make more than 2 entries. And so this entry down here on 8/2/22 is the recording of just a simple sale. So here you just made a sale, you sold your goods, and so you received cash. And so that sale was for $250. So let's just start down here on the credit side. And then you sold $100 worth of notebooks. And then you incurred a tax liability of $25, and that adds up to $375, which equals the debit side over here of $375. So you received $275 in cash. You had $100 in cost of goods sold. That was your inventory go out. And then you recorded a sale or a revenue account of $250, your products and notebooks, $100, and your sales tax liability, $25. So just to make that really simple, because I know that is very confusing. It took me probably at least 2 or 3 weeks worth of Principles of Accounting 1 in college to understand all of that. But just want to show you that to illustrate that in double entry accounting, you've got to make at least 1 entry on both sides of the equation in order to get things to balance. And this is why we often recommend people use software like QuickBooks, or you talk to your accountant, or you get an accountant, or hire a bookkeeper in order to do this for you. But this is the other method. And the reason that people use this method is because it gives a much more in-depth and robust understanding and look at your business from a performance perspective, to see really how you're doing compared to the single entry method. And I'm sure we're going to have some questions about that. Okay, so now we're going to get into the 2 different systems of when you record your transactions, your sales, or your revenue. And so this isn't like the time of the month. This has to do with when you receive the cash, or when you send the cash, or earn revenue, or incur, or earn money, or incur expenses. And so these 2 methods are called cash or accrual. And just to be real simple, all these are is one accounting method. The cash accounting method is what it's called, means that you record the transactions when you receive the cash. So if you make a sale and you receive the cash that day, you record that sale that day. Or if you have an expense and you give or you send that cash the same day, then you're going to record that when that transaction actually happened. You're recording it when the cash is sent or received, as opposed to the accrual-based system of accounting, where you only record things when when you've either earned or incurred the revenue or expense, regardless of whether cash has changed hands. So let me give you an example of accrual accounting. A lot of doctors, dentists, medical offices, they will perform services, for instance, today, but then they often don't get paid for 30 or 45 days. So the question is, when do they record that revenue that they earned? Well, if they're doing accrual-based accounting, they're going to record it today, on the day that they provided the services and that they earned those funds, even though the cash won't be received for 30 or 45 days. If that medical provider was operating on the cash basis of accounting, they would not record that revenue earned until they received the cash. So if they performed the service today, they would not record that revenue today. They would only record the revenue in 30 or 45 days when the cash actually hits their bank account. So these are two different methods of accounting. So one is cash-based, one is accrual-based. And it depends on what kind of business you are and how large you are typically, or how complex you are, which one that you're going to choose. So again, cash is going to be used for small or new businesses or specialized businesses like medical offices. If you're a medical office and you'd like to talk to me about why you might want to use cash accounting, I would love to talk to you one-on-one, because a lot of medical offices, it makes more sense for them to do that. Excuse me again. Accrual accounting is what larger, complex public companies usually use, or if there are multiple owners, or if there is a legal requirement for them to follow what's called the generally accepted accounting principles, or what's also known as GAAP, so GAAP over here, or if you just want a deeper understanding of your financial performance. So long story short, accrual-based accounting is really going to give you a more accurate picture of the performance of your business as it is actually happening, because it's recording things when things happen, not just when the cash changes hands. So the cash method is a little bit inferior because it doesn't always give you the best picture of how your business is actually doing. Because you can have a really great sales month one month, but if you're on a cash-based accounting system, those sales might only be shown spread out over the course of 3 to 6 months, because you're receiving the cash at different intervals over the future. And so if you look back on your business, a year from now, your sales might not look as large as they actually are in a given month, because that cash has been received in sort of a diffused manner throughout the year. Whereas if you're on an accrual basis and you have a lot of sales in one month, then all of those sales are going to be recorded in that month, and you're going to be able to look back and say, wow, that month we had a lot of sales. Because you're on the accrual-based method of accounting. So there's pros and cons to both. If you'd like to talk about your specific business and how you want to structure your business, I would love to talk to you about it. If you're wanting to do your books yourself, or if you don't have an accountant or a bookkeeper, or if you're a smaller, a new business, or potentially if you're a medical type office or provider, I would suggest the cash method of accounting. But as soon as you're able to switch over to accrual, I would recommend that you do. Okay. And so the last thing that we're going to cover today is the chart of accounts. So when you're doing all of this recording, whether it's single or double entry accounting, either cash or accrual-based accounting, you want to classify all of those entries according to certain accounts. And so the chart of accounts is sort of your master list, or it's a list of all of your transaction accounts in your business. So for example, if you're selling things, let's say that you sell, I don't know, let's go, old school, and say that you sell CDs, VHS tapes, and 8-tracks. You may want to look back on your business and say, which of those 3 different things did I sell the most of? And so then in your chart of accounts, you would want to make sure you set up 3 different accounts, one for CDs, one for VHS tapes, one for 8-tracks. I apologize if there's anybody in here who's too young to know what an 8-track is. Call your parents, I guess, or call me for consultation. I'd love to tell you about it, I guess you could say. So this is your chart of accounts. It's your master chart of accounts. It's just a list that's going to keep all of those different accounts that you want to be able to see as a business owner. So just like it says there in the first row, the first bullet point, it's a list of all transaction accounts in your business, and that goes for revenue and expense. It categorizes all of the transactions for analysis. So when you go back and you look at your business, you know what you're looking at. And then this chart of accounts is the classification system that feeds all of your financial statements and reports. So in order to start making your chart of accounts, it's really simple. You can literally just take out a piece of paper and a pen, or you can get an Excel and you can just, make a list. And these are the, where we got like 6, 7 categories here that you can do. You just want to list out everything that you've got. So the first section is just what you own or your asset accounts. So if you've got a landscaping business, and let's say you own 3 trucks and 4 lawnmowers, you want to write down, truck A, truck B, truck C, lawnmower A, lawnmower B, lawnmower C. And you want to write those down. You want to designate what they are. And each one of those assets, one of those large assets, is going to have its own account in the chart of accounts. This is also going to be your bank accounts. If you've got multiple bank accounts, you're going to want to write down every single one of those bank accounts because every one of those is going to be their own account in the chart of accounts. And then the next thing you want to do is what you owe. And there's 2 kinds of what you owe in accounting. One is what you owe to lenders, so like banks or credit cards. You want to write down those accounts, and those are called liabilities, potentially to suppliers of yours that you owe money to. And then the other type of what you owe is what is owed to the owners, which is also known as equity. So after all the liabilities are paid off, whatever assets are left over after the liabilities are paid off, that's what the owners own. That is the owner's equity, as we call it. And so if you've got multiple owners, you're going to want to know what their names are, and they're all going to have their own account according to percentages, but it's all going to be under the main equity account. Then you're also going to want to know, what are your regular expenditures? What do you spend every month? What are your regular expenses every month? So these are things like rent, utilities, payroll, just office supplies, advertising, marketing, all of those different expenses. You want to write down all of those that you have every single month. And if you want to group some together, so if you, like, for instance, utilities is often grouped together. If you want to look back in a year and say, what did I spend on utilities total? Then you could put, phone, internet, heat, air, or electric, I guess you could call it, or any other general utilities that you have, sewer, trash. And you can see how much did I spend on my total utilities for the year. And then you could have sub accounts in your chart of accounts under the utilities, and you can see how much you spend on each and every single one. And so you want to list out every one that you have on a regular basis. And then the last one, or the next to last one, is what you earn, so your revenue accounts. And that's what we were talking about a minute ago with the CDs, the VHS tapes, and the 8 tracks. You want to know which one did I sell the most of this past year? You won't know unless you have all of those accounts split out. If you just have it all together in one account, it'll be really hard for you to know, what your greatest product earner was. So you want to have those split out as well. And then I've got a star down there by cost of goods sold, because this is an inventory account that's kept a little bit differently, but you do want to make sure that the cost of goods sold is listed in your chart of accounts. So one recommendation to you, as soon as you get off of here and you're wanting to kind of understand your business a little bit better, sit down and make this chart of accounts of everything that's in your business and classify it according to these categories. So if it's something you own, it's going to be an asset. If it's something you owe to somebody else, it could be either a liability or the owner's equity. You want to write down all of your regular expenses and then where your regular revenue streams are coming in from. So another example of revenue streams would be, if you're a clothing store and you sell jeans and shirts, one revenue stream might be jeans, one revenue stream might be shirts. If you're a coffee shop and you sell coffee and food, one revenue stream would be coffee, another would be, food items. So real simple there. And so what these 3 things result in, the single or double entry accounting, so making those entries, those bookkeeping entries every week, and then creating your chart of accounts and classifying all of your expenses according to that chart of accounts. What that activity will result in is your financial statements and your financial reports that you're going to use to run your business, to analyze your business. So you'll see your bookkeeping, your accounting, your double entry, your single entry, your cash, your accrual, all of that activity that you do once a week, that is your bookkeeping activity, your accounting activity. That is the foundation that you have to have in order to get the statements and the reports you need in order to be able to run your business. So all of that is going to generate your income statement, also known as the P&L or profit and loss, your balance sheet, your statement of cash flows, your budgets, and your projections. And these are going to enable you to be able to evaluate your business, analyze your business, and give you the data that you need to drive your decision making. It's going to create a dashboard for you to do what I call flying the airplane of your business. You're going to have an instrument panel full of readings that are going to help you make really great decisions about your business. So what is the foundation, the financial foundation of a business? It's doing this bookkeeping, doing it every single week, every single month, and using it to create these financial statements and reports to be able to run your business. All right. So the next financial seminar that we're going to do is going to be on Thursday, September 23rd at 2 p.m. And all of you guys signed up for this seminar, so you'll know how to do that as well. You can go find that on our website, on our schedule of events, and I would love to have you there as well. We're going to take a deep dive into the financial statements and how to read them and how to use them and really tell you what they are. All right, so now I'm going to try to get into some of the questions. Let me pull those to the side over here. All right, let me read this first one. If you want a recommendation for an accountant, go ahead and give me an email. My email is back at the beginning. It is sl072@uark.edu right here. If you want to get in touch with me for an accountant, we've got several that we can recommend. All right, so let's see what else we have here. That looks like all we've got in the chat. Let me look at the Q&A. Nothing in the Q&A. All right, that looks like all we've got. If you've got any questions, now is the time to go ahead and put them in that chat box. And I'm going to hang around here for just a few more minutes. I'll pull back up some of those slides. Just while I'm waiting on some questions to roll in, one of the other most common questions I get is how often should I do my bookkeeping? How often should I be doing the record keeping? I'll give you two answers. So one is the IRS answer. If you ever get audited and the IRS wants to come and look through all of your books, they're going to expect you to update your financial records every single week. So that's the IRS standard. The small business standard is no less than every single month. So definitely every single month, but preferably every single week. If you've got an accountant or a professional bookkeeper doing your books for you, it is not unreasonable for you to ask them to do it or to keep it updated every single week. It usually takes them at least 2 or 3 days, so they're usually like a week behind. The way that this usually works itself out is that typically the 5th day of every month is when the books for the previous month should be completely closed. So usually in the big business, corporate business world, what we used to do was we knew that our accountants and our bookkeepers were going to close our books on the 5th or the 5th business day of every month. And so then the 6th and the 6th business day of every month, I would do all of my financial analysis and review. And then the 7th business day of every month, I would meet with all of my superiors and inferiors in the organization to sort of look through all that data together and have our financial meeting to evaluate our performance looking back, and then also to project the next month and quarter looking forward. So usually the 5th, 6th, and 7th business days of every month are the big financial business days for a business. What would I recommend? So I got a question. What would I recommend for a small startup for financial software? So if you've got some experience and you do enjoy doing numbers and repetitive administrative tasks, I just recommend QuickBooks for people. It is a really good tool. There is a learning curve. If you're very specialized in what you do, like if you're a really great salesperson, or if you're a really great baker or a welder or a really great, clothing, buyer and seller, or you've got some kind of unique skill that you're selling to your clients, you really need to spend most of your time focusing on doing that activity, and then hire a bookkeeper and an accountant to do all that to do all the bookkeeping and accounting for you. And your return on your investment on those funds spent is going to be one of the greatest returns on investment that you're going to get in your business, because it's going to allow you to really focus in. And a good bookkeeper, a good accountant for a really small startup business shouldn't cost more than a few $100s a month. Definitely no more than $500 a month if you're not a very complex business. But if you'd like to talk about how to get that set up and even how to have that first meeting with the accountant or the bookkeeper, I'd love to talk with you about that. Okay. Looks like we've still got everybody on too. If there's any more questions. QuickBooks is great. It helps you do double entry accounting without having to know all of the debits and credits. But I still usually recommend people having a bookkeeper or an accountant just to make sure you're doing everything right every month. Some simple things that you can do pretty easily in QuickBooks are just enter your expenses or your invoices, or when you receive cash. Those are fairly simple things to do in QuickBooks. I wouldn't mess with the journal entries too much. I wouldn't mess with your chart of accounts. I would definitely talk to an accountant or a bookkeeper about that, and just have a follow-up meeting with them about every week or so. Definitely try to meet with an accountant at least once a quarter just to go over your books to make sure everything's correct. Yeah, thank you guys so much. I really hope that it's helpful. And then when you're looking at your financial statements, you can see, the advantages between single entry accounting and double entry accounting. And if you're a new business and double entry accounting and getting an accountant using QuickBooks seems kind of overwhelming, you can do that single entry method. Sometimes for a while. There's some really simple Etsy businesses out there that still use the single entry method, and it's very, very simple to do. But then also, QuickBooks really is helping you do that double entry accounting. And then the cash versus accrual, if you can be cash based or you can be accrual based. I really like the accrual, but I know it's a little bit more difficult to keep track of if you're not an accountant or a bookkeeper. But would encourage you to move that way if at all possible. But you can definitely do cash, and you're just going to record those transactions when the cash changes hands. Yeah, so question was to summarize the questions that I would ask at a first meeting with an accountant. One would be, what can I expect of you as far as how often you're going to keep my books up to date? What does that process look like? Like, do I bring you receipts every week? Do I email you receipts every week? What does that look like? And then how often can I see my reports? Or do you use QuickBooks Online or do you use QuickBooks Desktop? Because if they use QuickBooks Online, you as the entrepreneur, no matter where you are, you'll be able to log in and you'll be able to see your financial data up to date all the time, as up to date as your accountant has it. If they use QuickBooks Desktop, then you're not able to log in remotely, and they're going to be sending you those financial reports probably once a month or so. So you're not going to get it as up-to-date information. You don't necessarily need to see it every single week unless you're a really fast-paced type business. If you're selling a whole lot every single week, if your throughput is really, really fast every week, but you do want an accountant that has that capability. The second thing that I would ask is, do you have specific experience in my industry? So for example, there are some accountants who specialize in the construction industry. It's a very complex industry with some very specific need to know knowledge. There's also accountants who specialize in the food and beverage industry because, for example, keeping food inventory in a restaurant and keeping that amount, accurate and usable is really, really difficult because the food is just flying through the restaurant all the time. And so accountants that have never done accounting or bookkeeping for the food and beverage industry, they don't necessarily know all those tips and tricks and best practices for that industry. So just, I would make sure that you try your best to find somebody who's got experience doing bookkeeping and accounting in your specific industry, whether it's nonprofit, construction, car shops, manufacturing, engineering, food and beverage places, that kind of thing. But those are the two biggest things that I would ask. Yeah, and then you could also ask, are you going to be doing the bookkeeping, or do you have a separate bookkeeper to do that? Because usually if an accountant is going to do bookkeeping for you, they're going to charge more because they've got a higher certification, but you're sort of, I don't really know how else to put it. If you're paying an accountant to do your bookkeeping, it's kind of like paying a doctor to be your nurse. You're sort of overpaying for what you're receiving. There's other people that you can pay less that are going to provide you the same service. So sometimes people will hire a bookkeeper separately than they hire an accountant, but they'll set up their accounting system with an accountant and then just instruct the bookkeeper how to do the bookkeeping according to those instructions. So if you've got an accountant doing your bookkeeping, you might want to say, do you have a bookkeeper who can do this at a little bit cheaper rate? Or should I hire somebody else, to do that bookkeeping for me? And then can you and I meet once a month or once a quarter just to go over these books to make sure that they're being done correctly, being done accurately, and that if there's anything that needs to be fixed, you can fix it. Absolutely, of course. Thank you all. All right. Again, I would love to talk to anybody one-on-one. Almost always available. I usually book appointments 2 or 3 business days out. You can just shoot me an email and we can get together and we can go over your specific questions. Just before we got into the financial statements in a couple of weeks, I really wanted everybody to try to understand, or be able to at least understand, how that data is populated into those financial statements. But I'm really looking forward to the class in a couple of weeks. So we've got about 3 more minutes left. And nobody can see your question. Everything's anonymous, so don't be afraid to ask anything. That's why we're here. You guys are great at what you do, and then we're here to help you take care of the business side of things. And I do believe we're going to post this video online on our website as well, if you want to go back and look at it. And I think Julie, my coworker, is going to send out this presentation as well, so you'll have access to it. Got another question. What financial elements should be included in a business plan? I would love to talk to you about that one-on-one. That's a long answer to a great question. But just shoot me an email and we can get together and talk about that. But mainly you're going to want your startup expenses, your monthly expenses for the upcoming 3 years, and then your financial projections for your sales for the next 3 years. And we've got a really great workbook to help you work through that. So definitely give me an email. We'll get together. All right, everybody. That's it. Thank you all so much. Really appreciate you guys, and hope we get to talk to some of you soon. And we'll see you all in a couple of weeks, hopefully. All right. Bye-bye.